Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders. Anyone who is registered for today's program will be receiving a copy by next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Now, please join me in welcoming our friends from Moss Adams, Naomi Johnson, Tax Senior Manager, and Allison Hand, Tax Manager. Naomi and Allison, I know you have a lot to get to today, so I'll let you take it away.
Thank you. Hello, everyone. Welcome, and thank you for listening. My name is Naomi Johnson, and I have with me Allison Hand. We're from Moss Adams and here to talk about navigating current and approaching tax changes. This is a big year for tax changes, so in our talk today, we're going to go over a couple of items that could be affecting you, including bonus depreciation, interest deduction, and the clean vehicle credit. We'll then discuss a couple of the sunsetting tax changes and what to keep in mind in the coming years. We'll end with a brief update on the reinsurance Form 8886. Bonus depreciation is a tax incentive that was created to encourage businesses to invest in new assets to help stimulate the economy. It accelerates depreciation expense, allowing companies to write off a large percentage of the cost in the year of purchase. When it was first enacted, you were able to write off 50% of the cost in the first year, and then the Tax Cuts and Jobs Act increased it to 100% write-off of eligible property. Starting in 2023, the percentage that you're able to deduct decreases each year. This year, it's 80% of a write-off, 2024 will be 60%, etc., until 2027 when bonus depreciation is set to expire. The remaining cost of the asset is written off over the life of the asset. So for example, computers are 5-year assets. So this year you could take 80% of the cost, and then the remaining 20% is taken over the next 5 years. 100% bonus depreciation has created a deferral waive, which is this concept of carrying a future tax bill at all times. And as long as you're adding new assets each year, like a loaner fleet, you get to keep postponing this deferral waive. In 2023, this is the year that some of this may become due, with the deduction decreasing to 80% instead of 100%. So are you planning for it? One way that you can plan for it is with the Section 179 deduction. Section 179 is an alternative to bonus depreciation and similarly allows you to take a first-year write-off on assets that you purchase. There's a limitation of 1.16 million, and it starts to phase out if you add more than 2.89 million in new assets. These amounts are marked with inflation, so they increase each year. The limitation on how much you can take on vehicles changes based on what it is and how it's used. So if it's a work-centric vehicle like shuttle vans or cargo vans, you can take the full amount for 179, and then company vehicles over 6,000 pounds and used at least 50% for business, you're able to take 28,900 in 2023, and then company vehicles under 6,000 pounds is only 11,160. Assets that are eligible and the limitations vary a little between bonus and 179. For example, roofs and HVAC, you can take 179 on, but not bonus. And while you can take bonus depreciation into a net loss, you cannot take 179 to a loss position. The other thing to keep in mind is certain owners are not able to benefit from 179. Trusts are not eligible to take it. Passive owners are not eligible. Then if you're married filing separately, you're able to take it, but you have the limitation between the two of you, so you have to be careful that it's not double counted. Now I'm going to pass it over to Allison to talk about the limitation of business interest.
Thank you, Naomi. You're likely already aware of the law that limits the deductibility of interest expense that the Tax Cuts and Jobs Act expanded in 2017. With rising interest rates, this limitation is increasingly important to pay attention to. The deductible amount of business interest expense is limited to 30% of the taxpayer's adjusted taxable income plus business interest income. The adjustments to taxable income to arrive at adjusted taxable income previously allowed an add back for depreciation, amortization, and depletion. However, starting in 2022, the limitation changed and these items cannot be added back anymore. With not being able to add back depreciation in 2022, we saw several of our clients have their interest expense be limited for the first time. The good news is there's a special carve-out in the law that allows for full deduction of floor plan interest. However, this comes with a catch where bonus depreciation is then completely disallowed. As you're planning for the phase-out of bonus depreciation that Naomi discussed over the next several years, it will be important to consider the impact that the interest limitation rules may have on your ability to take bonus depreciation. Interest limitations are calculated at the filing entity, and any interest expense you have disallowed in the current year can be carried forward indefinitely. We wanted to walk through a quick example of the impact of this change that started in 2022. In this example, we have a dealership with $1.1 million of interest expense, which is made up of $930,000 of floor plan interest and $180,000 of regular business interest expense. They have $2.8 million of book income for the year, and the only book to tax difference is depreciation expense. Depreciation expense would include $500,000 of bonus depreciation, assuming the business is allowed to take bonus depreciation. That would be a total of $780,000 of tax depreciation expense. In 2021, both the depreciation and interest expense would have been fully deductible. Under the 2022 rules, this taxpayer is no longer able to add back the $870,000 of depreciation expense when they compute their interest limitation. So they run into a limitation and are forced to use the special carve-out for floor plan interest, and this makes it so that they can't take bonus depreciation. The disallowance of bonus depreciation has a net increase to taxable income of $400,000 for the year. Assuming a 29.6% individual tax rate on flow-through income that is eligible for the qualified business income deduction, this results in $778,000 of tax due versus $660,000 under the previous rules. With the rising interest rates we've been seeing over the last couple of years, we expect it will be increasingly common to see this scenario where bonus depreciation is disallowed. So it's something you'll really want to keep top of mind when planning for year end. Now we wanted to move to talk about the updates to the clean vehicle credits. The Inflation Reduction Act of 2022 made several changes to the tax credits for clean vehicles effective as of January 1st, 2023. These included adding fuel cell vehicles and adding a new credit for previously owned vehicles. For vehicles dealers have been selling throughout 2023, they've been required to provide tax credit seller reports to buyers with the necessary vehicle details to claim the credit. A copy of the report goes to the customer on the date of sale, a copy is kept with the sales paperwork, and one copy will be submitted to the IRS after year-end. The IRS has not released any details on the method of reporting the 2023 tax credit seller reports. However, what we do know is that they will be due January 15th, 2024, so be on the lookout for more information as year-end approaches, and don't wait to start gathering copies of the reports that will need to be submitted. While the IRS hasn't quite figured out how to report for 2023, they have released instructions for 2024. The IRS launched registration for the IRS Energy Credits online portal November 1st. For vehicles sold January 1st, 2024 or later, dealers must be registered with the IRS Energy Credits online and use the tool to electronically submit time of sale reports. These reports will be matched against VINs provided by the manufacturers to be verified and accepted in real time and must be provided to the buyer at the time of purchase in order for them to claim a clean vehicle credit. An initial user authorized to bind the dealer with the IRS should register for the IRS Energy Credits online portal before year end and will need to complete a registration for each separate location with a unique tax ID. They will then be able to designate additional users to complete time of sale reports when the IRS releases that functionality in December. In order to register, they will need the business name and address, and it needs to match what's listed on file with the IRS, the tax ID of the dealership, and then if they are registering for advanced payments as well, they will need the dealer state license number and proof of license and the bank account and routing number they would like to use. Whoever is registering as the authorized representative will also include their name as the authorized official, mailing address, phone number, and email. For advanced payment registration, this allows the dealer to request advance payment for transferred tax credits when submitting their time of sale reports. Only licensed dealers may register for this service, and the dealership must be in current tax compliance with the IRS in order to receive advance payments. We've seen clients have issues with their registration, so don't wait to complete it. Make sure you know the information that the IRS has on file to get the registration accepted timely. For dealers who want to receive advance payments, there's a 15-day waiting period before the dealer will be able to start receiving payments, so you'll want to register for advance payments well before year end. For transferred tax credits, the IRS expects to pay dealers within 72 hours of the date of an accepted time of sale report. The bank account that you choose when registering currently can't be changed.
Make sure you choose wisely.
The income qualification for the credit is going to be the responsibility of the buyer, not the dealer, which is important to note. Dealers will not be responsible for paying back any credits that buyers take that then they find out that they no longer qualify under the income requirements. I'm going to turn it back over to Naomi to talk about sunsetting tax changes.
Thank you, Allison. Another Tax Cuts and Jobs Act item I'm sure you're aware of is the qualified business income deduction. This allowed business owners to deduct 20% of their income gain deduction and loss from pass-through entities, such as partnerships, S corporations, and sole proprietorships, assuming that they meet the other limitations. This brings the highest tax rate of pass-through income from 37% down to 29.6%. As the law stands now, this is set to expire, and with no congressional action, there will be an automatic tax rate increase in 2026 of 7.4%. For illustration, if you had $1 million of taxable income from your pass-throughs in both 2025 and 2026, you would pay an additional $74,000 in tax in 2026 with this provision expiring. This is something to keep in mind as you're talking to your advisors about year-end planning and potential flexibility of when to pick up income. For example, if you have a remodel on the horizon, can it be delayed to 2026, or is it worth opting out of bonus depreciation or 179 in order to save more depreciation deduction for these higher tax rate years? Another thing to think about is if you might want to opt out of LIFO and you are picking up that income over the next 4 years. Do you want to start now in these lower tax rate years? Another provision that is set to expire we want you to be aware of is the lifetime estate and gift deduction. In 2023, the lifetime estate and gift exemption is $12.92 million, $25.84 as a married couple. This means that you can gift up to this much and not have to pay any estate or gift tax at the federal level. State levels vary. The amount is adjusted for inflation and will increase in 2024. The annual gift exclusion is $17,000 in 23 and will increase to $18,000 in 2024. This means that you can gift this much to each person annually before triggering a gift tax return requirement. The higher lifetime exemption is set to fall by more than half at the start of 2026. The tax rate is also set to increase this year, in that year, from 40% to 45%. Gifts that are made prior to the exemption drop are locked in. In other words, gifts that you make now won't be retroactively subject to the estate tax later. But planning for these large gifts can take time, especially if you're thinking about gifting or selling your business, as this will require evaluation, and lawyers and accountants are going to get increasingly busy as this deadline approaches. So we encourage you to start thinking about them now.
The IRS issued proposed regulations on reinsurance arrangements in May of 2023 that may not be favorable. In response, NADA has drafted a comment letter with suggested changes to the proposed regulations. You should watch for final regulations to be released in the coming months. Hopefully, they will incorporate NADA's recommendations. We have seen little audit activity from filing Form 8886 on a protective basis, and you should consult your tax advisor to evaluate whether Form 8886 needs to be filed based on the proposed regulations. Thank you to AIADA for having us and all of you for joining us to talk about how to navigate a few of the current and approaching tax changes. Here's our contact information if you have any questions and would like to reach out.
Allison and Naomi, thank you so much for joining us today. We know it's a busy time of year over there, so we appreciate you taking the time. Again, you will all be receiving a copy of this webinar by next week. To those on the line, join us back here next Tuesday, November 28th at 2 p.m. Eastern as Carfax and ACV join us to talk about future costs. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great Thanksgiving, everyone.